$603. That is how much the average Australian mortgage repayment has climbed every single month since the tightening cycle began. And here is the number that should really worry you. Almost half of that increase is money that never touches the actual house. It is pure interest evaporating before a single brick of equity is built. Most borrowers do not find this out until they're 3 years into a 30-year loan, staring at a statement that says the balance has barely moved. So today, the question everyone keeps asking in comment sections, at dinner tables, in group chats with far too many exclamation marks, is it still worth buying? Or is renting quietly becoming the smarter move over time? 3 things are coming up. First, the exact point in the cash rate cycle where renting stops being the cheaper option and starts being the more expensive one over time. Second, a capital city right now breaking every national rule in the book, growing at a pace that makes the rest of the country look like it is standing still. And third, a structural variable almost nobody talks about, one that can swing the entire rent versus buy equation by tens of thousands of dollars, regardless of which city, which suburb, or which decade someone buys in. Let's set the scene. The Reserve Bank of Australia has held the cash rate at 4.35%, the endpoint of a tightening cycle that pushed it up from 3.60% earlier this year. 3 separate hikes, each one landing directly on mortgage repayments within weeks. The average new owner-occupier variable rate now sits somewhere around 6.2%, though several lenders are pricing new loans closer to 6.9%. And the average new home loan? According to the Australian Bureau of Statistics, it now sits at roughly $735,000, up about $75,000 in just 12 months. That is not a typo. That is the price of admission rising faster than most incomes can keep pace with. Here's where the math gets genuinely ugly. On a $735,000 loan at 6.2% over 30 years, the total interest paid across the life of that loan can exceed the original loan amount itself. Borrow $735,000 and, depending on the term, repay well over $1.5 million once interest is added. That is the number banks do not lead with in the advertisement. Add in stamp duty, lender's mortgage insurance for anyone under a 20% deposit, conveyancing, building inspections, and the moving costs nobody budgets for, and the true upfront cost of buying can sit tens of thousands of dollars above the advertised purchase price. Compare that to renting the equivalent home. Nationally, the median weekly rent sits around $681, according to CoreLogic. In Sydney specifically, that median climbs to around $817 a week, the most expensive rental market in the country. On the surface, that sounds like renting is also brutally expensive, and it is. But the monthly gap between renting that median home and servicing a mortgage on a similarly priced property can run into the hundreds, sometimes over $1,000 a month in the most stretched capital cities, once the buffer APRA requires lenders to apply, a full 3 percentage points above the actual loan rate, is factored in to what a bank considers serviceable. But wait. Before anyone rushes to cancel their pre-approval, there is a reason buyers have historically still come out ahead: capital growth. Nationally, dwelling values rose close to 9.9% over the past year, according to CoreLogic's Home Value Index. On a typical capital city home, that is tens of thousands of dollars in equity created in 12 months. Equity a renter simply does not accumulate. Run that same growth rate out over a 10-year horizon, even allowing for slower years, and the long-term wealth gap between a buyer and a renter who never invests the difference can stretch into the hundreds of thousands of dollars. So, where is the crossover point, the moment the math actually flips? Property analysts generally point to a 5 to 7 year holding period as the rough threshold where buying costs, stamp duty, loan fees, the higher short-term outlay, get diluted enough by capital growth and equity building that owning overtakes renting and investing the difference. Here's the callback stat that makes this personal. A meaningful share of Australian mortgage holders refinance or sell within that same 5 to 7 year window, often right before the point where owning would have paid off. The rule sounds simple. Buy and hold past the flip point, and buying tends to win. Buy and bail before it, and renting may have been the smarter financial choice all along. Now for the localized exception, because national headlines lie by omission. While Sydney and Melbourne have recorded flat to negative monthly growth for stretches this year, Perth has posted annual growth above 26%, according to CoreLogity's chart pack, a gap of roughly 24 percentage points against Melbourne's growth of around 2% over the same period. That is not a rounding error. That is two entirely different property markets operating under the same national cash rate, the same national headlines, and wildly different outcomes. Someone applying a Sydney story or a Melbourne story to a Perth buying decision is working from the wrong data set entirely. Here is the hidden third option almost nobody mentions in the rent versus buy debate: rent vesting. Buy an investment property somewhere genuinely affordable and high-yielding while continuing to rent in the lifestyle location that is otherwise financially out of reach. Picture two people on similar incomes. One saves for years trying to buy in an expensive inner-city suburb outright, delaying entry while prices keep climbing. The other buys a smaller, higher-yielding property in a growth market, keeps renting where they actually want to live, and lets rental income plus capital growth do the heavy lifting. Over several years, the second person often builds equity faster without sacrificing lifestyle or location. So what actually drives the entire outcome? Three variables matter more than almost anything else. First, interest rate sensitivity. Every 25 basis point movement in the cash rate reshapes monthly serviceability by hundreds of dollars on an average loan, which is why the difference between buying at 4.35% and buying if rates were 50 basis points higher can swing affordability dramatically. Second, time horizon, the single biggest lever in this entire debate, because holding period alone determines whether upfront buying costs get diluted or dominate the outcome. And third, the one nobody talks about, opportunity cost. Money tied up in a deposit is money not invested elsewhere, and depending on where else that capital could have gone, the cost of a deposit is not just the dollar figure, it is everything that dollar figure could have otherwise earned. Consider a first home buyer in their early 30s on a solid full-time income, trying to decide between locking in now at current rates or waiting for a possible future cut. Every year of hesitation at close to 10% annual capital growth nationally can mean the target property becomes tens of thousands of dollars more expensive by the time a decision is finally made. Meanwhile, national rental vacancy sits at just 1.7%, well below the long-run average of around 2.5%, and annual rent growth has re-accelerated to around 5.7%. Waiting does not freeze the cost of renting either. It simply moves the goalposts on both sides of the ledger at once. Now the reframe, because this should never be one-sided. Renting is not simply throwing money away, despite how often that phrase gets repeated. Renting buys flexibility, the ability to relocate for work, to avoid the transaction costs of buying and selling, to sidestep maintenance bills, council rates, and the risk of buying into a market right before a downturn. For someone uncertain about where they will be living in 3 years, renting can be the financially disciplined choice, provided the money that would have gone toward a deposit is actually invested rather than simply spent. Zooming out, Australian home ownership rates among younger age groups have been trending gradually lower for decades, a shift driven less by any single interest rate cycle and more by structurally rising prices relative to incomes over the long run. The real question was never a simple binary of renting against buying. It was always about time horizon, discipline, and what happens to the difference between a rent payment and a mortgage repayment. $603 a month in rising repayments on one side, a median dwelling value climbing 9.9% a year on the other. Neither number tells the whole story alone, but together they are the entire debate in miniature. Whichever side of that ledger someone lands on, the decision is rarely about which option is universally right. It is about matching the choice to a genuine time horizon, a realistic borrowing capacity, and a willingness to actually invest the gap rather than simply spend it. The market will keep moving either way. The only real question left is which side of the crossover point a person expects to be standing on 5 years from now.